Your next reading is Topics in Demand and Supply Analysis, end of chapter questions extracted from your CFA Level 1 curriculum. If the price elasticity coefficient of the demand curve for paperclip is equal to -1, the demand is elastic, inelastic, or unit elastic. If we take the absolute value of the coefficient of elasticity or elasticity coefficient, if it's greater than 1, it's elastic. If it is less than 1, it is inelastic. And if it's equal to 1, the absolute value, ignoring the negative sign, then it's unit elastic. So since we have exactly 1, so that makes C to be the correct option. Next, the demand for membership at a local health club is determined by the following equation. Quantity demanded of the health club membership is equal to 400 minus 5 times of price, where QDM is the number of health club members and PHM is the price of membership. If the price of health club membership is $35, the price elasticity of demand is closest to. We know how to calculate. The price elasticity of demand is equal to change in quantity demanded upon change in price multiplied by the price upon quantity demanded. Now, this factor is already given here, -5. What we need is to take this price, which is 35, and replace P with 35. If we do, we'll calculate the quantity demanded. It's 400 minus 5 into the price 35. If we simplify this, 5 times 35 and deduct it from 400, will give you 225. So simplifying this gives you -0.778, and that makes A to be our correct option for this question. Next, question number 3. Price elasticity of demand for a good will most likely be greater if there are no substitute for the good. If there are no substitute for the good, the price elasticity of demand would be less than 1. Incorrect. C. Consumers spend a small portion of their budget on the good. In this case, price elasticity of demand would be less than 1 because the spending is very small fraction of your total earnings or total budget. Then what about B? Consumer consider the good as discretionary, so you can just kick that good away if you don't want them. So since it's discretionary, avoidable, so in this case, the price elasticity of demand would be greater than 1. So that makes B to be our correct option. Question number 4. If the income elasticity of demand for a product is -0.6, irrespective of the options given, we can just interpret it ourselves. If the income elasticity of demand for a product is -0.6, what does it mean? If the income increases by 1%, the quantity demanded for that particular product will fall by -0.6%. Or, put it this way, if the income increases by 10%, the quantity demanded will fall by 10 times of 0.6, that is 6%. So look up the options there. A 1% increase in income will result in 0.6% increase in demand. Wrong. Decrease, not increase. 1% increase in income will result in 0.6% decrease in demand. Correct. That's what we have just discussed. And then totally, of course, this is totally other way around. 0.6% increase in income will result in 1% decrease in demand. That's wrong. It's the other way around, in fact. So that makes B to be the correct option. All right, next. An individual demand curve for onions is given by the following equation. QD for onion, quantity demanded for onion, is equal to 3 times of 0.05 P naught, or PO basically is the price of onions, plus 0.009 I represents the household income, minus 0.16 PT. Here PT is the price per pound of tomatoes. Alright, so if the price of the onions is 1.25, household income is 2,500, and the price of the tomatoes is 3.75. The cross price elasticity of demand for onions with respect to the price of tomatoes is given closest to. So cross price elasticity of demand is equal to change in quantity demanded of onions upon change in price of tomatoes multiplied by upon. Alright, so we have this factor given right here, negative 0.16. Now we can replace price of onions with 1.25, income with $2,500, and the price of tomatoes as 3.75. If you simplify all of this, this should give you 3.75 times 0.16, and all this would give you 24.84. Or take up to 4 places after decimal. Now replace the price of tomatoes, 3.75, upon the quantity demanded at this price, 24.8375. 83. In fact, the whole number was 24.8375. So when you simplify, you get negative 0.0242, and that makes B to be your correct option. B it is. Movement along the demand curve for a good X. This is your demand curve. Expansion, contraction, sliding up, down. This occurs only because of the change in price. So, the price of good X, if the price increases, the quantity demanded contracts. If the price decreases, the quantity demanded expands. So, it's expansion and contraction in demand. You're moving up, down the same curve. So, this is because of the price of goods. How does income affects the quantity demanded? Income, the price of substitutes, these are the demand curve shifters. Shift inward, outward. Shift to the right, shift to the left. Increase in demand or decrease in demand. There are many terms used for this. So right now we have B as our correct option. Moving on. A wireless phone manufacturer introduced a next generation phone that received a high level of positive publicity. Despite running several high-speed production assembly lines, the manufacturer is still falling short in meeting demand for the phone 9 months after the introduction. Which of the following statement is most plausible explanation for the demand-supply imbalance? There's more demand, but we are unable to supply that much that is needed. So what could be the most plausible explanation for this imbalance? The phone price is low relative to the equilibrium price. Exactly, that's what would have caused this. So this is supposed to be the equilibrium price. This is supposed to be the equilibrium quantity. So the price might be somewhere here. At this point, the quantity demanded is more, the quantity supplied is less. So this imbalance has resulted in shortage. More demand, less supply. So the phone price is low relative to the equilibrium price. That's the perfect option, correct option. Why not B? Competitors introduced next generation phones at a similar price. Now that would have resulted in more supply of this type of product in the market, so we would have seen such a shortage in the market. So it's not a correct option. Consumer incomes grew faster than a manufacturer anticipated. Well, yes, income increase could result in increase in demand, but that's not one of the plausible reasons we're looking for. A is the most appropriate one. There is a shortage at this attractive price and the firm is unable to meet the demand, and that makes A to be the correct option. The situation described is one of excess demand. In order for markets to clear at a given level of quantity supplied, the company would need to raise prices. Next. The market demand, the following information relates to questions 8 to 11. The market demand function for 4 years private universities is given by the equation. Quantity demanded, and QDPR represents the number of applicants to private universities per year, is equal to 84 minus 3.1 PR. That's the average price of private universities, plus 0.8 I, and I is the household monthly income in thousands of US dollars, and 0.9 PU, that is the average price of public or government supported universities. Assume that the PR is equal to 38, which means this can be replaced with 38. Income is 100 in thousands of US dollars, and PU is 18. Now if you replace these with the numbers, what you will get is 62.4. So quantity demanded at these variables is 62.4. What are we looking for? The price elasticity of demand for private universities is closest to. Price elasticity of demand. So this is the gradient of the function here. So price elasticity of demand is equal to, I'm going to just write it this one right here, multiplied by price upon quantity demanded. We have the price given here as 60, this given here 38, divided by 62.4. So negative 3.1 times 38 upon 62.4 will give you negative 1.9. So this is the price elasticity of demand for private universities. You just had to replace the numbers, use the formula appropriately, and you got your answer. Next. Same data from 8 onwards to question 11. The income elasticity of demand for the private universities is given as income elasticity. So it means you're talking about this coefficient. So income elasticity of demand is equal to plus 0.8 times income, that is 100 in thousands of US dollars, upon the quantity demanded, that was calculated previously as 62.4. So if you simplify, it's going to be 1.3. Next question relating to the same information given. The cross price elasticity for private universities with respect to the price of public universities closest to. So we need cross price elasticity of demand. It's equal to the coefficient for cross price elasticity here in this function is given as 0.9 times price 18 private for public universities, and the quantity demanded calculated previously 62.4. If we simplify this all, you'll get 0.3, and that perfectly matches with your option A. Previous one 1.3 was there as C, and we have already done the previous. Next, Question number 11. If the cross price elasticity between two goods is negative, the two goods are normal goods, substitutes, or complements. Let us just take this way. Forget about this example. Take the case of Pepsi and Coke. If the price of Pepsi goes up, people will demand less of Pepsi, quantity demanded will fall, and at the same time, the quantity demanded for Coke goes up. So there seems to be a positive relationship between these two goods, and these are called substitutes. For substitutes, the cross price elasticity is positive. Then replace it with bread and butter. Bread, butter. If the price of the bread goes up, the quantity demanded of bread will go down, and since bread and butter, they are jointly demanded, they are complements, so the quantity demanded for butter will fall as well. So as you can see, they are negatively related. So the cross price elasticity between two goods is negative. The goods are classified as complements. The goods that have joint demand or that jointly demanded or complements. So that makes C to be the correct option. Next, in the case of normal good with a decrease in own price, which of the following statement is most likely true? When the price decreases, the quantity demanded should increase. Both the substitution and income effects lead to an increase in the quantity purchased. True. When the price falls, people now are able to purchase more of it. And decrease in price will also result in substitution effect. So the decrease in price would result in higher quantity demanded because both substitution and income effect, they will both reinforce, thereby it will lead to increase in the amount purchased after the drop in price. So that makes A to be the correct option. Look no further, we got our answer. 13. For a given good, given goods are those goods with the increase in price, they are demanded more. In other words, when the price goes up, the quantity demanded goes up as well. So for such goods, the demand curve is positively sloped. Look no further, it's A. Demand curve is positively sloped. In this case, income effect overwhelms the substitution effect, and that's the case of goods that are just like iPhone. iPhone is a given good. When the price increases, the people purchase more of it. So that makes A to be our correct option. Normal profit is best described as, well, it's a very straightforward question, textbook based. Zero economic profit. Normal profit is the level of profit such that the implicit costs and explicit costs are just covered. So that is the normal profit. Total revenue minus all explicit costs, that is accounting profit. So A is the right answer. A company plans to hire additional factory employees. In the short run, marginal returns are most likely to decrease if the factory is operating at full capacity and if you hire more employees, so your marginal returns will decrease, are most likely going to decrease. Right? It's just like the same typical example that we give in our classes. When you have a single ladder and there are many people on the ladder picking apples. So if you're already running at full capacity, addition of new employees will result in decreasing marginal return. So look no further, it's a fairly straightforward question. So that makes A to be the correct option. Basically, it's just the application of law of diminishing returns, that in the short run, if the capital is kept fixed, you're operating at full capacity, additional labor will not result in higher outputs marginally higher. So marginal returns are likely to decrease. So basically, you will simply add the cost, but there is not going to be enough addition in output. So that makes A to be the correct option. The production relationship between the number of machine hours and the total products for the company is presented below. When we employ 1 machine hour, this is the total product. 3 by 1, this is the average product. When the machine hours employed are 2, the total product is 8. Average is 8 by 2, 4. So in this column, we have the total product units, and this is the average product. The diminishing marginal return first occurred beyond which machine hour? All right, output increased here by 5, then by 6, and after this there is decrease, and then further decrease. So diminishing marginal returns first occurred beyond machine hour, beyond third machine hour. Diminishing marginal return is observed beyond third machine hour, so that makes A to be the correct option, because after this point the marginal product is 5 and then further 2. So from this point onwards it starts decreasing. So that's A. A is the right answer. Next. The marketing director for a Swiss specialty equipment manufacturer estimates the firm can sell 200 units and earn total revenue of 500,000. However, if 250 units are sold, the revenue will total $600,000. So we need to calculate the marginal revenue per unit associated with the marketing 250 units instead of 200 units is close. It's a fairly straightforward question. This is the revenue expected for 250 units and this is the revenue expected for 200 units. So if you take the difference between these two revenues, that is $100,000 or whatever the currency is, divided the difference in units, 250 minus 200, that's 50. So if you divide 100,000 with 50, it means you're talking about 200,000. That is the marginal revenue per unit, and that perfectly matches with your option A. Next, an agricultural firm operating in a perfectly competitive market supplies wheat to manufacturers of consumer goods, consumer food products, and animal feeds. Right? If the firm were able to expand its production and unit sales by 10%, the most likely result would be, since you are operating in a perfectly competitive market, and if you expand your production units by 10%, since you are the price taker, so you just by increasing the unit output, you will only be able to increase your total revenue. Average revenue in the perfectly competitive market stays the same for all firms. An increase in the total revenue of less than 10%, this is incorrect because you are operating in a perfectly competitive market. So if you increase your unit sales, price stays the same and unit sales increases by 10%, so your total revenue goes exactly up by 10%. So that makes A to be the correct option. An operator of ski resort is considering offering price reductions on weekday ski passes. At the normal price of 50 euros per day, 300 customers are expected to buy passes each weekday. At a discounted price of 40 instead of 50, we are expecting 450 customers to buy passes each weekday. So as the price falls, the quantity demanded increases. So what are we looking for? The marginal revenue per customer earned after offering the discounted prices is closest to. That's a very straightforward question. So when the price is 50 euros, we are expecting 300 unit sales, so that gives you a total revenue of $15,000. The price is decreased to 40 euros, we are expecting more revenue, units sold 450, multiplying 450 by 40. So it's going to be 18,000 euros. So what's the difference in revenue? That's 3,000 euros. And this difference has been caused by how many units? 300 and 450. The difference in units is 150. So dividing 3,000 euros with 150 more sales in passes or 150 additional units, that would be $20. So your marginal revenue per customer is €20, not $20. So that makes A to be the correct option. The marginal revenue per unit sold for a firm doing business under conditions of perfect competition will most likely be equal to average revenue. We just discussed this previously. In perfectly competitive market, your average revenue is equal to your marginal revenue is equal to price, and that gives you A as your correct option. Straightforward textbook based question. Next question number 21 to 23 is based upon this information. A firm's director of operations gathers the following information about the firm's cost structure at different levels of output. These are the quantities, this is the total fixed cost, stays the same within the relevant range, and the variable cost increases as we produce more units. What's the question? Refer to the data in Exhibit 1, this one. When quantity produced is equal to 4 units, the average fixed cost is closest to, so a fairly straightforward question. This is your fixed cost, total fixed cost, and this is the quantity. Simply divide 200 by 4, so it's going to be $50. That's your average fixed cost, and that matches with your option A. A is the right answer. Same data. Refer to the data in Exhibit 1. When the firm increases production from 4 to 5, the marginal cost is closest to. Since fixed cost doesn't change, that's the change you are seeing here. The cost is increasing from 240 to 320. So basically there has been an increase of 320 minus 240, that's the difference. So it's for 1 unit increase in quantity, your marginal cost rose up from this 240 level to 320, so that's the difference of 80. So that makes C to be the correct option. Change in total cost. I ignored fixed cost even though it's a part of your total cost composition. But since even if you consider or ignore, the major difference, the main difference will be from these two levels of variable cost. 240 versus 320, that's 80. And that makes, otherwise normally what, the longer way of doing it. So the total cost at this level is 440. Total cost at this level is 520. Now, how we define the marginal cost? That is the change in total cost, which is again 80. Change in production, that's 1. So 80 by 1 is again 80. So whichever way you come. But this is recommended because maybe fixed cost can take step. Yes, it is possible in production process. Fixed cost can take steps if the level of production exceeds the predetermined established level. So the fixed cost can take steps. So in that case, it's recommended to use the total cost and then take the difference and divide with the quantity. So that makes C to be the correct option. Next. Refer to this data in Exhibit 1. The level of unit production resulting in the lowest average total cost is closest to. First, we need to calculate the total cost because this is total fixed cost, total variable cost. So we need the sum of these two columns as our total cost. It's going to be 200, 100 plus 200, 300, 150 plus 200, 350, 400, 440, and then finally we have 520. We need average total cost, so we'll simply divide it. First, this is irrelevant. 200 by 0 is infinity, undefined. So 300 by 1, 350 by 2 is going to be 175. Then we have so we know exactly what we are doing. So it's going to be 400 divided by 3, 133. 440 divided by 4, that's 110. And then finally 520 divided by 5. So average cost falls to as low as 104. So when you increase the scale of your operation, the fixed cost tends to be spread over larger number of units, hence your average total cost falls. And that's what's happening. So the question says, refer to the data in Exhibit 1. The level of unit production resulting in the lowest average total cost is at the 5th unit of production, because as you increase the number of production units, your fixed cost on per unit basis falls, hence your average total cost falls as well. So that makes C to be the correct option. Next, in short-term break-even point of production for a firm operating under perfect competition will most likely occur when price equal to average total cost. Well, this is the right option. Under perfectly competitive markets, the price equals marginal revenue, right? Because the market is in perfectly competitive state, so every firm is a price taker. So a firm will break even where the price is equal to average total cost. Where the marginal revenue is equal to marginal cost, that is the profit maximizing level of output, right? So A is the right answer. It's a fairly straightforward question. Next, the short-term shutdown point of production for a firm operating under perfect competition will most likely occur when you are unable to cover your variable costs even. When your price is not sufficient to cover your variable cost. That's a situation where you cannot sustain in the long run, even in the short run. So this is the point where the firm should shut down because your revenue is not sufficient enough to cover your variable cost. So that makes C to be the correct option. Under conditions of perfect competition, a company will break even when market price is equal to the minimum point of, that's what we just discussed a little while ago, average total cost curve, A. Right? A company set to break even if its total revenue is equal to its total cost. So under conditions of perfect competition, a company will break even when the market price is equal to the minimum point of average total cost curve. Next. A company will shut down production in the short run if the total revenue is less than the variable cost. If the firm cannot just cover the variable cost involving direct material, direct labor, variable overheads like electricity, gas, water, indirect material, indirect labor that vary with the level of production. So if the firm is unable to cover the variable cost, the revenue is not able to cover the variable cost, it's the point that the firm should shut down in the short run. B. Next, a company has total variable cost of 4 million and fixed cost of 3 million. Variable 4, fixed 3. Based on this information, the company will stay in the market in the long run if you are able to cover not only your variable cost but as well as your fixed cost. Your revenue should have to be at least 7 million in order to cover both of your fixed and as well as the variable cost. So that makes C to be the correct option. When the total revenue is greater than total variable costs but less than total cost, you are able to cover your variable cost, then you have the right to stay in the market at least within the short run. So the firm should stay in the market. Exit is recommended when the revenue is not sufficient enough to cover your variable cost, but still variable cost is covered but not the full cost. So at least in the short run the firm should stay in the market. That makes B to be the correct option. A profit maximum is least likely to occur when? Whether it's perfect competition, monopoly, monopolistic competition, profits are maximized when the marginal revenue equals marginal cost. That's what we have already learned, already settled. It is not a necessary that when average total cost is minimized, then the firm will have the maximum profits. Because the profit is the interplay of revenue and cost, not just the cost alone, revenue as well. So we can't just assume that at total cost, the minimum point of total cost, the profit is maximized. This is the point where the profit is maximized, when marginal revenue is equal to marginal cost. So this is where the profit would be maximized. The difference between the total revenue and the total cost is maximum. This is also where the profit is maximized. So B and C are maximum profits, and the least likely option is A. Clearly, it's the odd man out, and hence the right answer. 31. A firm that increases its quantity produced without any change in per unit cost. When you increase the quantity produced and your per unit cost decreases, that's when we say the firm is experiencing economies of scale. When there is an increase in quantity produced and there is an increase in the unit production cost, then we say the firm is experiencing diseconomies of scale. But when the firm increases its quantity produced without any change in per unit cost, it means then there is no cost change, then it's constant return to scale. C. Next. A company is experiencing economies of scale when cost per unit increases as output increases. That is basically diseconomies of scale. It is operating at a point on the long run average cost curve where the slope is negative. Correct. That's the correct option. Economies of scale occur when the firm increases its output and cost per unit starts decreasing. B is the right answer. Diseconomies of scale most likely result from specialization in the labor force that will result in reduction in average cost. So this is the feature of economies of scale, not the right option. Overlap of business functions and product lines, that's where the problems come. That's where the firm starts becoming inefficient. When the firm increases in size, then it's become difficult. There are communication issues, inefficiency creeps in, and the firm experiences diseconomies of scale. Discounted price on resources when buying in large quantities, that is the economy of scale, called the purchasing economy of scales. So this is not right. We're looking for the diseconomies, and B is the diseconomies of scale. Next. A firm is operating beyond minimum efficient scale in a perfectly competitive industry. To maintain long-term viability, the most likely course of action for the firm is to do what? Now here's the problem. The firm is operating beyond minimum efficient scale. Since the firm is operating at greater than the long run efficient scale, so the firm might experience diseconomies of scale. So what it should do, not operate at the current level, not increase, rather decrease its level of production to the minimum point on the long run average total cost curve. C is the answer. Under the conditions of perfect competition, in the long run, firm will most likely earn normal profits. Fairly straightforward, textbook based question. If you have read well, you will be able to do this question fairly easily. The following information relates to question 36 and 37. The manager of a small manufacturing firm gathers the following information about the firm's labor utilization and production. Refer to the data in Exhibit 2. The number of workers resulting in the highest level of average product of labor is closest to. So average product means 150 by 1, 320 by 2, 510 by 3, 170, 660 by 4, 165, and then 800 divided by 5, that's 160. Now, the number of workers resulting in the highest level of average product is 170, that is 3. That makes A to be the correct option. Yes. Next. Refer to this data. The marginal product of labor demonstrates increasing return for the firm if the number of workers is closest to but not more than. Let's see. The marginal product 150, 320 versus 150. That's 170. Then 320 versus 510. That's 190. 660 less 510, 150. And 800 less 660 It's 140. Well, you can see the highest marginal product is at 3 level. So the question is, the marginal product will ever demonstrate increasing returns for the firm if the number of workers is closest to but not more than 3. That makes B to be the correct option, and hence it ends the topics in demand and supply analysis.